was a question about the mutual agreement process, the MAP process that you would have read or looked at or seen mentioned in the double tax agreements and in some of your reading materials. And this is generally provided for round about Article 25 of most DTAs, read together with Article 26 on the exchange of information. And this is where a particular double tax scenario arises. And a classic example is a transfer pricing adjustment. Let's say a transfer pricing adjustment, an upward transfer pricing adjustment was made in South Africa, and it affects, let me give you an example. Let's say South Africa charged a royalty for a brand of 1%. To many different subsidiaries. Let's pick Uganda as an example. Uganda paid 1%, and when Uganda paid 1%, they got a deduction of 1%. Now South Africa makes the adjustment and pushes it up to 2%, whereas Uganda still would only have claimed a 1% deduction. You would then enlist the competent authority in Uganda to approach the South African competent authority and vice versa, so that if that adjustment in fact stands, and it stands as the final percentage, that there now is an opportunity, or that the competent authorities at the insistence of the taxpayer will get the two tax revenue authorities to speak to each other, so that if there has been a 2% upward adjustment in South Africa, there'll be a 2% deduction in Uganda, or something in between, whatever it is those two countries decide is fair under the circumstances. Very important part of any dispute. The moment a dispute such as a transfer pricing dispute commences, it's very important to initiate the MAP process, because there usually is a time period of, if I remember correctly, 3 years from the time that the dispute takes place. And that dispute effectively commences when the revenue authority concludes their audit and raises the fact that they are charging, in my example, a 2% royalty, whereas only 1% was deducted in Uganda. And so we've argued in one of our cases that if the matter goes to court, let's say in South Africa, the South African matter cannot be decided upon by the courts until such time as the two competent authorities have had an opportunity to negotiate with each other and to come up with some sort of a compromise. And it's because that's the compromise that will ultimately be the one that stands, unless the taxpayer decides that it is going to go to court on whatever that agreement is, in order to reduce the exposure, in my example, in South Africa from 2% downwards. So a very important component, the moment that there is a dispute that gives rise to double taxation. And here we're talking about economic double taxation. We're not talking double taxation about the same taxpayer. Remember, the one taxpayer is in South Africa, it's an entirely different taxpayer in Uganda. They're associated enterprises. And the fact that that adjustment creates this skewed result gives the opportunity for those respective taxpayers to approach their competent authorities and to initiate this mutual agreement procedure to try and get them to compensate for what the upward adjustment was in South Africa, to compensate for that in Uganda, by way of a fairly simple example.